Hello, investors. Well, precious metals investors pay close attention when Don Durrett shares his views, a longtime analyst of gold and silver mining companies and the founder of goldstockdata.com. Don has built a reputation for identifying strong opportunities and spotting turning points in the sector. We always love to hear from him. With gold recently breaking through historic highs and investor interest surging, his perspective certainly comes at a critical moment. Fresh off the Beaver Creek Precious Metals Summit, Don is here today to share his impressions of the event, highlight the companies that impressed him the most, and provide context for where the sector may be heading. So, Don, welcome to Stocks to Watch.
Hey, Ashley, ready to do another show?
Well, Don, it is always such a pleasure to have you on. So I know you attended, as I mentioned, the Beaver Creek conference this year. What were your overall impressions of the event? Did anything really stand out? Any companies stand out compared to prior years?
Yeah, the one thing that was surprising to me was how many quality stocks that I found. I did two write-ups on my Substack and Twitter. First one was a top 10 list that it ended up being top 11. And then I did another one, honorable mentions, that had 15 names. So I was 26, and then I left one off, so it was 27. So I found 27 really good stocks. So that kind of surprised me because, the market has been up over 100% off of its bottom. You would think that these stocks would start to get pricey. That's not what I found. I've found that these stocks remain extremely cheap. It's kind of puzzling that we've moved this far and we're still so early. These stocks still need to double, maybe not double, but they need to go up substantially more before they start to get pricey. Versus because this has such a long way to go still. I still think that this is going to be at least a 2-year bull market, at least. So, we're not at an all-time high in silver yet. And that's just a nominal high. So that was probably the most surprising thing I saw. There's so many stocks that were incredibly cheap.
Yeah, and so many companies that you found were great companies. So maybe you could kind of give us an idea of which companies you found most impressive as like investment opportunities, and those during your meetings at the conference. Before we continue, be sure to subscribe to our channel and ring the bell to get notified about our latest videos.
Yeah, first thing I want to say is investing in mining stocks is speculating, it's not investing. So if it's speculating, only invest what you can afford to lose. These stocks, you can't really pick winners with mining stocks. You can't just say, okay, I'm going to pick 10 stocks or I'm going to pick 3 stocks. It doesn't work that way. It's a very unusual business. Mining companies don't have they don't have competitors. They don't have customers. Mining companies, Barrick and Newmont, do not compete against each other. They basically both mine gold or mine silver out of the ground and then sell it to sell it to whoever they have a contract with. But basically, they're not going to have any problem selling the gold. The hard part is getting it out of the ground. All these companies do is dig up gold out of the ground and sell it. It's a very strange business. The valuation, 80% of the valuation is based on what the price of gold is, what the price of silver is. Has nothing really to do with the company. There's a lot of luck involved. You basically stake out some land and you end up finding a big mine. And, like, for instance, Barrick just found this beautiful mine in Nevada called 4 Mile. It's a thing of beauty. They didn't know that when they staked it out. It was just luck. And there's a lot of, finding a gold mine is like a lottery pick. It's so much luck involved. So that's what I mean. It's uber speculating. So I want to predicate that. We're not investing here. You are gambling. This is gambling. You might, if you're going to make baggers here, 3-bagger, 5-bagger, 10-bagger, you're not making baggers without risk. It's not like you're not buying Microsoft here. Microsoft, that's why Microsoft's been around for, I don't know, 30 years. That's why they've been, and they've been around for probably 30 more. In mining, these companies can disappear. Argonaut was a very strong gold miner. They disappeared. They're gone. Boom, poof. Basically, couldn't make any money. Had to sell the project. I mean, we see this all the time. So I just want to predicate that, right? So I'm going to throw some names out there, but this is gambling. So the first stock that I found two very good risk reward 25 baggers that were somewhat shocking to me. The first one was 1911 gold, which it actually gapped up. So the conference was Tuesday through Friday, and I released my my top 10 and my number one pick on Friday night, and then it came out over the weekend, and it gapped up on Monday because people read my write up on 1911 gold, and it's really a thing of beauty. I mean, it's up. I think not 100%, but probably up 75% since the show. But crazy, it's still a 25 bagger. So I said it was a 50 bagger, and it's still a 25 bagger. It's so crazy. So they have a mine in Manitoba called True North that went into care and maintenance. That mine was valued at $1 billion in 2011. It was a company called Sandgold. Sandgold went bankrupt. And then 1911, I think it was another company before 1911 got it, and then 1911 got it. And I'm like, all they need is higher gold prices. Sandgold would still be mining that mine if gold price would have never crashed. It's a 1 million ounce deposit. It's actually more than 1 million, but True North alone is 1 million. Then they have probably another 500,000 ounces on the property. Plus they have discoveries. It's basically a 2 million ounce mine, maybe bigger, but the mill's just sitting there ready. They've been running it. I mean, the CapEx is low. It's one of those things that is just sitting there waiting for the gold price to go up. And investors to this day are acting like, oh, they'll never turn that thing on again. We got gold at $3,700, and they're like, oh, I don't need to own that stock. They'll never turn that mine back on again. Well, guess what? They're going to turn it back on. It's kind of silly cheap. That one, like I said, it's up like 100% since the conference. It doesn't matter. I always say that when I can find a five bagger, I use future gold prices. This is big time speculating, right? I repeat, do not invest for the current gold price. I say it's $3,700 gold. I don't care. I'm investing for $5,000 gold. If we don't get to $5,000 gold, then I'm kind of screwed because my whole speculation is all based on $5,000 gold. And so I'm just going to sit here and hold these stocks. So if gold doesn't go to 5,000, it gets to like 3,800 and then crashes, I'm going to crash and burn with it.
Right.
So so for 1911, the whole thesis is $5,000 gold. But if we get there, it's a thing of beauty. And so that's where the speculation comes. So you basically speculate gold price is going to 5,000. The True North mine is going to grow to production to 100, 120, 150,000 ounces. They get there, we get paid. That's kind of what it comes down to. So I use future gold price. Then I use checkboxes. When a checkboxes is like a data point and check off the box, make sure that they have it. And for a development play, high quality development play, I've been doing this for 20 years. They need to check all the boxes. And when I find a company that checks all the boxes and for a development play, I want it to have 10 bagger upside. And the reason why is because I want at least a 5 bagger. But if it doesn't have a 10 bagger currently, the chances are it's probably going to go down to a 5 bagger. So I'm kind of like in a range, 5 to 15 bagger. So if I want to start with a 10, if I start with a 5, I have no room for error. Everything's got to be perfect for me to get my 5 bagger. And so That's one of the check boxes. So this one, it actually printed as a 50 bagger, which is kind of insane. Um, and then the location, and I'll go down my checklist. The location is important. So they're in Manitoba, great location. Uh, Solid property, solid long life mine, great project, good economics. That one checks the box. Management team, they have a really good board, good management team. That's important. Insiders, really important. I've always found that if you don't have at least 25% insiders, there's a really good chance that project will never get turned on or get first pour because they end up selling. The sharks show up and the sharks want it. It's like, wait a minute, you're a 50 bagger. I want you. So they go in and they steal it from you. So there's that. And then the next one is a path to production. And you can need all these check boxes. And so the path to production, and this is the one thing where so many times I've gambled on companies that don't show me a real strong path to production, and it bites me. It's important, and this is where you have to talk to management and see if they really believe in the project. If they really believe in the project and they have the insiders, they're like, we're building this thing. No one's stealing it from us. I love those management teams that have a plan, tell me the plan, and they're just carrying it out. And 1911 has that. They're like, this is what we're going to do. I actually released a YouTube video that you guys can watch where the CEO basically lays out the plan. And so that's what you're looking for. So those check boxes. Mm-hmm. So the next one was, and I actually think that these two companies should merge. The other one is called Talisker Resources. It's in British Columbia. It's that their mine is actually bigger than True North, bigger than 1911, and they're cheaper than 1911.
Wow.
So that would be a really good combination because Talisker doesn't have enough insiders to ward off the sharks. But if they merged with 1911, that would go away because then they'd have enough to fend off the sharks, and they could build that company into a 300,000 plus ounce producer. And potentially build it and grow it into even bigger company. I just love that. When I see two companies that have a really good fit, I always kind of mention it. I always used to talk a lot about Maritime and Newfound Gold. That's a perfect fit. Maritime has the mills. They have two mills. Newfound needs the mills. Come on, guys. And they did. They merged, which was a great thing. The third one I'll mention is Jaguar. So Jaguar has always been a bit of a sleepy company. They've never been aggressive on M&A. All they do is just plod along, make some money. Nobody's really been excited about the stock. Hasn't really been growing production very quickly. But guess what? They got a new CEO. And he's like, I really like this guy. He's got 30 years experience. He's a Brazilian. He worked for Kinross. I mean, he's a really sharp guy. And he basically he came in there and he put a plan down. 5-year production increase plan based on current what they currently have. Exploration plan to grow resources just on their existing properties from 3.5 to 7 million ounces. And then M&A. That one is so. Those are the three stocks that I really got excited about there. But there was actually 26, but we don't have time to talk about 26 names. But people can go to my Substack and read both articles for free, and you don't have to sign up. Any free article on Substack you can read without signing up.
And Don, where can they? I mean, if they don't know, so on Substack, do they search your name? Where
my name? Yeah, my name.
Okay, perfect. Just so that they're aware. Really find it interesting. So it's Jaguar. Is it Talisker?
Talisker.
Yeah,
okay. Resource.
And 1911 gold. Interesting. Yes. And I like how you kind of lay out all of the elements that make them compelling investment opportunities. And you seem really excited about them. So if you're excited, I can't imagine that investors wouldn't be excited. Exploration, mining, receiving really renewed investor interest, would you say? But there still are some constraints. So when you were at the conference, what did you notice about like buyer sentiment? And what does that suggest about the outlook for the sector overall, would you say?
On the whole, I thought it was somewhat subdued,
Hmm.
considering it was, it's over 200 companies. It's completely sold out. It's mainly professionals. You got to be an accredited investor to get in. So it's not a retail crowd. So, you know, I mean, it's basically people with professionals. So it was somewhat subdued, but there was also an undertone of optimism because there has to be. I mean, the stocks have been moving, so it was a strong undertone, but on the whole, there wasn't a giddiness yet, and the reason why is because we even though the miners are doing well right now, um, the miners aren't in charge yet. They haven't really went to the front of the line, but they are going to. And I think that subduedness is this recognition that it's getting ready to start here.
Hmm.
There's like an anticipation. There's more anticipation than giddiness. So the giddiness will occur when the stock market goes down. And that all that money, there's 63 trillion just in the US market and over 100 trillion globally. And then even more than that in bonds. So you got about $250 trillion tied up in assets that are at risk.
Hmm.
And so that money will have to find a place. Where's it going to move to? Now, the aggressive people that want to make money, they're going to go into a lot of them are going to go into the miners. If you look at the percentage of people that have money in miners, it's less than 1% of which is absolutely insane. The average investor has less than 1% in miners. Basically, they don't have any. So you have the average person is in 401k plans and S&P 500. They don't have any exposure to gold and silver miners, zero, right?
Talk
And the
about
people,
untapped resource.
it
Hello.
is, it's pretty massive,
Yeah.
and then the people that do have exposure, kind of, they don't have a high exposure, 5% maybe, 3 to 5, but they're kind of rare. My point is this: is that when the stock market finally goes down, if it doesn't, and I believe this is what's going to happen, if it doesn't rebound, if it doesn't basically get its mojo that it's had for 15 years. I mean, just look at the S&P chart. I mean, all it's done is gone up for 15 plus years. If it doesn't do that, and I think what's going to happen is, historically, this is mind blowing. Most people that don't know this, the average person, if you ask them, there's no way in hell they would give you the right answer. And I'll ask you the question, and you'll probably get it wrong. Okay, since 1929 to today, has there been more up years or more, up years versus down years? I mean, air periods. I mean, overall, is it more bullish or more bearish since 1929?
Ooh, bullish.
No, it's been much more bearish. You
Mm,
had you had decades of no growth. You had 1929 to 19
true.
45. That was like 10 years. Then from 1965, when Warren Buffett basically sold all of his stocks, all the way to 1980. So you had 10 years there, 15 years there. Then from 2000 until 2013 was the 13 years. It's actually been more bearish than bullish when
Mm,
you look at history, which is like, what? That's impossible. Because we had the 80s run, we had the 90s run, we've had the last 15 years. It's got to be, it's got to be, you have to make money in markets.
right.
No, when the markets stop going up, they don't go up when we peaked in 2000 in the stock market, we didn't get a new high till 2013.
Mm,
13 years. And that was recently. And so even though the stock market appeared to be running from 2009, it was still just retracing. It was just still trying to get back to its high. And so same thing happened, after the 29 from the 1930s, the same thing happened in the 60s. Um, so the 60s all through the 70s. And so you have that's one thing that people don't realize. And so when this stock market stops going up, I don't think it's going to go back up,
mm,
which is bizarre, because I think what's going to happen is it won't go back up. And so eventually what they'll have to do is a reset of some type.
yeah.
I don't know when the reset's going to be, 27, 28, 29, somewhere in there. I think it's going to be 27, but there's going to be a combination. There's so much money in the stock market and people are trying to make money in stocks. So we have over leverage and debt, governments, corporations, households. Then we have uber over leverage there. Then we have all of our assets in stocks and in housing, mm-hmm. and also in bonds. All three of those are going to go down. Mm-hmm. So all three of those will go down, and people will lose their jobs, unemployment will go higher, and the economy won't restart. You can imagine, you just connect the dots if those events happen. So when that all begins, when that all starts, if you will, the winner is gold. And so the mining stocks, that's why I say it's going to last at least 2 years. That's when the giddiness starts. I think next year at Beaver Creek, everybody will be giddy because everybody will be up about 200% on their portfolios, looking to double again. So we've doubled once, we'll double again at Beaver Creek, and the sky will be blue. We're like, we've doubled twice and we're getting ready to double again. So that's my overall view of Beaver.
Yeah, fascinating. And it really sounds like the sentiment this past week was cautiously optimistic, still discipline. Investors, they want strong fundamentals, not stories, right? I mean, would you say that? And they, as far as the investors that are watching here, what would you say it's gold. Go gold, go for gold. Yeah.
So the difference is most people don't have vision of what's coming. Mm-hmm. And so they basically think backwards instead of forwards. They have a recency bias and they have a normalcy bias. So most people are nervous, and I get emails about this every day. They're nervous about this gold going down, the stock market correction, their stocks go down 20, 30, 40%. And they're like paranoid that they're going to lose their wealth. They're like, people only think quarter to quarter, year to year. I don't. I could care less about the next 12 months. I think in terms of the price. We're not going to get to 5,000 gold in 12 months. So 12 months to me is just an opportunity to buy, if you will. But the average investor doesn't think forward. Because they basically have the mentality nobody knows the future, and that's why 80% are the sheeple and 20% are kind of the leaders, right? They know where things are going. I've always been a visionary. I've always I look forward. I don't look backwards. The only thing I look backwards on is history to tell me where we're going. Connect the dots to see where we're going. And I saw it very early that there's only one outcome here. And that outcome is the U.S. bond market basically breaking down. And people are like, well, you can't invest that way because you never know what's going to happen. You can do it. There's no reason why you can't do it. So you look and you say, okay, who's going to be the winner? Well, the winner's going to be gold. Well, if gold's the winner, that means the gold mining stocks are going to be the winners. And if that's the case, silver's going to follow. So they're going to winners too.
Yes.
And so you need to think that way. But it's hard for people to think more than, a week in advance. But I'll tell you this, right now, the average American knows that something's not right. The average American, especially people that have a lot of money, that are invested, have stuff to lose, if you will. But even the people that have nothing, they know stuff's screwed up because they can't afford a house. And so there's that. So both sides of the aisle basically know something's wrong. But the people with money especially know something's wrong. They're like, okay, I've made all this money, but why aren't I happy? No, I'm not talking about their personal lives. I mean their economic lives.
Yeah.
My portfolio is basically brimming at the top. I've been doing fantastically well. Why am I worried about my finances, right? The average investor is worried right now. And the reason why they're worried is because they can see, even though they don't like to look into the future, they can see when they start to look at various things that it's not really adding up well. We have a $2 trillion deficit, which doesn't seem to be going down, right? We just keep seeming to roll this debt over, and the debt just keeps getting bigger, bigger, bigger. So that's worry number one. It's like, whoa, we need to get that under control here, people. But the big budget bill, big beautiful bill, didn't fix that at all. That was not a let's fix the budget bill. That was a spending bill. And so people are worried about that. Then we really haven't had any type of a business cycle correction. Even in 2008, where we had a big problem, the Fed basically came in and rescued it and said, we're not going to let anybody fail here, which is not how you're supposed to run a capitalist system. A capitalist system is supposed to kind of regenerate on its own. Let the losers fail, and then we get back on our own. And that's what we did in the 60s and 70s and early 80s. We let the economy kind of get back on its feet on its own. Perfect example is 1978 to 1982. We let things get out of control. I don't know if that's the right terminology, but we let things fail. And then we slowly, we took the federal funds rate went all the way to 18%. That's not quantitative easing. That's quantitative. I'm going to break your back, right? And so that's how you're supposed to run an economic system. You let things fail so it can regenerate. And look what happened from 82 to 1999 because we let it regenerate. Well, we didn't let it regenerate in 2008. And so now people are like, uh-oh. And now what we have is we have all these zombie corporations. 10% of the corporations, at least 10% are not making money. At least 10% basically can't make money. That's a big chunk. And it's bigger than that. Those are just the companies that, literally are dead and they're zombies, but they're being kept alive by their creditors. And then you have probably another 10% who basically are not making money, but a little bit stronger, if you will, that are at risk. Then the average consumer is broke. And we know this. The average consumer cannot pay their bills. They're like, just, how do I get through this month? What am I going to buy? They have no discretionary income. And it's not getting better. And now we have this housing bubble. And everybody can see the housing bubble. Nobody can afford a house. So that's a problem. And now Trump throws the tariffs on top of it. So when you start connecting the dots, it's really difficult to be optimistic about the U.S. economy. If you're optimistic about the U.S. economy today, you're in denial. You're living in a bubble. You're pretending. You're basically pretending that everything's okay. You're living in a bubble, and that's Wall Street today. And so the average person recognizes what I just said. And that's one of the reasons why gold is going to be the winner, because today, are you going to run to put your money in short-term bonds or cash or money market funds? Are you going to be really comfortable holding on to dollars when inflation keeps kind of just rug pulling you? Are you going to put it in stocks? No. Are you going to put it in long-term bonds? No. So there's not a lot of places to go hide, if you will. And ironically, a lot of people are going to put it in short-term bonds or money market funds. But what they don't realize is that back in 2008, the money market funds came under stress. They're not so risk-free. The two big illusions today is that U.S. Treasuries are risk-free and money markets are risk-free. We're going to find that that's not true. And that's when gold's going to do its thing.
I like that. Don, it's always such a pleasure to talk with you. And I love to listen to your philosophy. I love to listen to your advice. Your analysis always reinforces the sense that, gold and silver, I should say, the mining sector there, is really at a pivotal juncture. And I think we are too, from what you're saying, what it sounds like you're saying. So thank you, because your advice always remains consistent and you're focusing strictly and solely, it sounds like, on quality. In many different senses, just from those three companies that you mentioned earlier. So we certainly appreciate you here on Stocks to Watch, and it's Don Durrett's goldstockdata.com for those investors who are interested in learning more. Thanks again, Don.
One final word I want to say about quality. The one thing is a lot of people that are going into gold and silver mining stocks, they do not understand the difference between a producer, a developer, and an explorer.
Huh.
And so many people think that they're the same and that I can invest in exploration companies and kind of get the same risk reward as a developer. It doesn't work that way at all. Exploration stocks are somewhat inelastic to the gold price. That's the reason why people get really excited about them. If an exploration company makes a discovery, it really doesn't matter what the gold price is because they just found some gold in the ground. And we don't know how much they found. They're probably going to find more. So people are going to buy it for that inelasticity. It's basically a thing of beauty when it happens, but the risk reward is absolutely terrible because it's really difficult to find big mines. I've found that the risk reward in exploration is literally terrible. So I've created 2 rules for people to use to talk about quality, right? You want to have an edge. And so with exploration companies, you don't have an edge unless only under 2 conditions. The first one is optionality. So you're buying gold and silver in the ground at a very, very cheap price, and you're waiting for the gold and silver prices to go up, so they go up. So rising tide scenario. It's basically like printing money. It's really hard to lose money when you buy like silver in the ground for 25 cents. You just wait for that company to go to $50, $1.50. So there's optionality. The second one is you only want to buy early in the Lassonde curve. And you don't want to do too many of these. These are very high risk, but you might do 1 or 2 of them. And it's mainly gambling. But early in the Lassonde curve means that you're buying a company that's very cheap. It's basically its market cap is like down there at 35, 50 million. And they just made a really good discovery hole. That's rule number 2. If they don't follow those 2 rules, then just pass. Or you can ignore exploration all the way. I have 83 stocks in my favorites list. I own all 83, and those are my favorite 83. And there's only 1 exploration play in the whole list. 1 out of 83, only 1. And the reason why is because I'm chasing elasticity. And those are stocks that basically benefit from higher gold, silver prices. An exploration company doesn't necessarily benefit. They're more inelastic. But the developers and the producers are highly elastic, and they will just absolutely rip. That's why 1911, which is a developer, they went up like 100%. And they'll just keep going up as the price of gold goes higher. They're very highly elastic. So I wanted to mention that because so many people think that they're the same, and they're not. You can read my book to learn more. It's on Amazon. It's easy to find. Just go there, look for my name, and look for the gold silver book with a black cover. Thanks for having me on, Ashley.
Thanks for joining us. That was fantastic.